Welcome back, traders. I'm watching another ICT lecture today, the NASDAQ review for April 30th. This is the Wednesday of NFP week. After this one, I'll only have one more lecture to catch up on, so let's go ahead and get started.
All right, so first and foremost, let's take a look at yesterday. Here is Tuesday's daily candle. And inside this little area right there, that is a volume imbalance because the wicks bridge the two bodies together, but there's no body laying in there. There still has yet to be a body laying inside that little area. So the market opened, traded down into that here, and also this wick, this candle right here, it's wick. I'm measuring that to get the consequent encouragement. That's what that red line is here. Okay, and in case I forget about it, I might talk and forget this. This wick right here is a draw, and the consequent encouragement is this level here. Okay, so for like non-farm payroll, Thursday and Friday, I think that might be a upside draw. And then if it gets really animated, the high here, and then that small little volume imbalance right there. Okay, so that's kind of like what I'm expecting. I'm not demanding it, obviously, but that's what I think is probably unfolding. But I could be wrong. It's not farm payroll, so don't be taking trades based on what I just said. Also, looking back to this wick here, okay, that consequent encouragement there, that's that there. But now it was a premium draw on liquidity when we were down here. Remember that? And then now, because we went above it, this would actually become a discount wick. Okay, so I'll actually change that color. These are all things I should have done before. Dude, you could have did all this in 5 minutes. You know, I like dragging you across the coals, the ones that don't want to be here. And so yesterday we had, again, the market open, trade down to that volume imbalance and consequent encouragement of this candle's wick. That's half of the wick's length. And then it traded higher and took out the previous day's high and traded inside of this wick. So if we take that wick and we add now the 25 level and the 75 level, these are all pertinent. Those are all still likely targets, if not the high itself going into non-farm payroll Friday. Okay. The reason why I think that's likely to occur because it's come down and filled in even this gap in here. So we have a separation between this candle's low, this candle's high, and we traded down into that today. And it's came off that pretty aggressively. So yesterday started the run up, and I think they came down and stopped everybody out. That would be long ahead of Thursday and Friday non-farm payroll, and then we'll see what we get. I could obviously be wrong, but again, these are the details as to why I believe what I believe.
So I was away for most of this week and did not do my usual analysis, so it's nice to see what ICT was looking at on the higher time frame, pretty much matching my own kind of bias. I want to quickly mention that this balanced price range here, well, even though you may be looking at the gap down here thinking, hey, price may want to come back down here, which it could, but because of this balanced price range, it's going to take a lot to get through it. So I think price will want to take some more buy side before thinking to revisit this gap. At least I would say this high over here.
So we're going to jump right down into a 1 minute chart and cut to the chase. Monday review. I stated that you can go in and do this fair value gap. Okay, remember I had the higher one up here. I took that off so that way our tension's right in here. Notice that fair value gap is also inside that daily volume imbalance, the blue shaded box here. Again, pause the video, rewind it until we're talking about the daily chart, and you'll see what that blue area is here on the daily chart. Well, that fair value gap is inside of that. And I told you to draw that out, and those that did were surprised to see how it came down and hit that. But I want you to take a look at what was also seen. We have relative equal highs. This is why I do the PowerPoint slides, because I ain't got to do all this stuff back and forth. This high and this high. So they're relatively equal. That means there's lots of buy side above this high here. They took the sell side out there, and we dropped down into consequent encouragement of that blue shaded volume imbalance there. Just fell short of that there. And then the low here. It's the short-term low there, that buy sign and bounce, sell sign efficiency. Now, when you look at that, look at the bodies here respecting that fair value gap. I told you it would become an inversion fair value gap. Monday's night review for Tuesday's trading. You trade down into that here, consequent encroachment of the fair value gap. And again, if you're not clear as to what I'm talking about here, again, look at the Monday market review, and you'll see this has been suggested to you to draw it. I didn't do it in my chart, but I told you you can do this too. And those that did it would have it on their chart Tuesday's trading, and it trades down into it here, hits it, rallies back out, and then the body supporting it here at the high. We stab down to it one more time, and then we start to run away, and then it comes right back down into the daily volume and balance high. See that? Then it rallies up back into the new week opening gap and clearing the buy side multiple times, and then picking up the sell side here and here, and rallies up, continuing into the rest of the day. In the afternoon trade, I showed you that. I'm just going to point review on all that again. The new week opening gap was used later in the afternoon and evening during the Asian session, and then used as resistance here, sold off. All of these things, consequent encroachment like that, all these things I mentioned during the Saturday space is what you're seeing here in the chart. It's beautiful to see it deliver as outlined, and it repeats over and over again. And I mentioned the buy side the other day. That's this level here, and in that new week opening gap, it's been working basically those levels back and forth.
All right, so I'm not a fan of this style where he goes back and forth in the chart. It's very hard to follow along, but if you do go back and pay attention to the time at the bottom, maybe that will help you out. He glazes over a lot of things very quickly. Maybe you'll get some insights if you go back through it slowly. I will do that eventually, but for now, I'm just going to go ahead and continue on as he moves into Wednesday's trading.
And then today in Telegram, I told everyone, I posted basically this chart here. I said I was watching this inversion fair value gap where it was used here, and it broke down. Once we traded inside the new week opening gap, I'll let you watch the videos in the Telegram channel. I'm not going to rehash that because there's a lot of good information in those very short videos. If you're not a member of the Telegram channel, then I guess you won't learn about it. It's not that big of a deal. It's not earth-shattering, but it is something that I think is pertinent to building consistency and know what you're looking for. And then we trade down into the 25th of April's opening range gap. We pause here, drop down into it, use it as resistance here, and then finally gives another drop lower. And then we have the market reaching down in short-term low. And then here's news. And this is my Venom model. Now, if you're new, you don't know what my Venom model is, I only taught it introductorily. I just coined that term if it's not real. I'm not sure if it is, but if it isn't, I got dibs on it. The way it works is, first you have to know what you're looking for. In this case, higher prices. Why? Because it's been dropped all day long. And here is your sell side liquidity. I have a video tutorial on this, so you can go back and watch it. But there's sell side here, and they drop it down through the low, but they do it with a CIVI. Sell side of balance, buy side of efficiency. Then they do a few candles down here, and then they send it ripping right back up. And that single candle going back above that low is a BISI. So we have a strong one-sided candle going down to take the liquidity, a couple candles left underneath that low to absorb all the sell stops for accumulation purposes, and then they displace it higher. This is the two fangs that make up that model I call Venom. And they're injecting the venom into these sell stops. So fang 1, fang 2, then leads. Okay? So I don't want to kill the joy of watching the Venom video that's on my YouTube channel. This is not all there is to Venom. There's a lot of other things that I'll have in a book format.
So if you remember, Venom is a model based around turtle soup. He's only introduced the basics of it, but if you're into studying it, here is my checklist from what I've seen so far. First, you need bias. I'm guessing this will be a higher time frame bias. Then a stop hunt with fair value gap. So this is the turtle soup and the so-called first fang. Remember, this is a stop hunt in the opposing direction of our bias. So in this example, it's going down when we are bullish. This is the first entry, but it will also be hard to enter here, at least for me, because I base my stop loss off of existing market structure. And since there's nothing here I can see, I will have to have a stop loss based off of an arbitrary amount. So even though this is the first entry, it is also the scarier entry. Then shortly after, we have a reversal fair value gap. Now, I don't actually know what to call this, but basically a fair value gap that is now going along with our bias. This fair value gap should overlap the first one, making this our second FANG. And because these fair value gaps overlap, it creates a balanced price range. And this second fair value gap is the second entry, and it's the, well, I won't say safer entry, but less scary entry because you have structure here. So you know to have your stop loss at the low. Now, this example is a fairly wide stop in terms of amount, but if you aim for this high, that'll get you a 1-to-1 risk to reward. But if you're looking higher, we have these relative equal highs here. And if you go for this is going to give you, I think, a better than 1-to-3 risk to reward. So that's basically it for the checklist, just these 3 things. But remember, this is just the basics. There's a lot about the Venom model that we don't know yet, a lot of stuff he hasn't released, but this is a good starting point if you want to study this model and try to discover some things for yourself. Now, I do have a few suggestions on things that you may want to consider. One thing is this second fair value gap, the second FANG, doesn't need to have a change in the state of delivery. In this example, we see that it does, but how often does this happen? Does the setup still work if we don't have a change in the state of delivery prior to the second entry? These are the types of questions you should be asking yourself and answering them when you study a model. Now, the second suggestion still deals with this second FANG. You'll notice that ICT marked out 50% of this fair value gap. For this model to work, do price need to stay in the upper half of the fair value gap? Can we wick into the lower half? If we do, does it still work? How often does it work? Etc. Now, you may say, what's the point of knowing this? Well, let's say hypothetically, in your back testing, you find that 90% of the time when this setup works, this second fair value gap remains unfilled. This means you can reduce your risk by, instead of having the stop loss at the low, you can put it at the bottom of this fair value gap, therefore reducing the amount of risks you have. And then when you reduce your risk, you might be able to take on more size. But this is just a hypothetical example. The last suggestion I have is the time. Does this setup happen at certain times? Now, I would think so because we have to have a stop hunt, and typically that happens during macro times. Here you can see the stop hunt happens during the 950 to 1010 macro. Now, this is just my hypothesis, but if you're wanting to study this model, I encourage you to study when do these models appear.
Right, so I'm looking for a entry before this candle's high is taken out. I'm going to be buying. Now, there's 2 ways you can do it. You can do it as a buy on a stop. So buy stop, this candlestick's high, you can buy it that way. Or if you're trying to keep a tighter stop loss, you can be buying at this candlestick's open or less. Okay, so it's a power 3 type of entry model. So opening price comes in at 19,174 even. So you can put a limit order in. As soon as this candlestick closes and you open a new one, the limit order goes in at this candlestick's opening price at 19,174.00. You put the limit order in, and in this candlestick here, you'll see that I got filled there, and you can see that there. See that? Look real close right in here. I'll try to zoom the video in. There is that little caret symbol that tells you where the actual fill is, and there's the numerical value. Now, the stop loss on that trade is this BISI. And if you look at where I have the fib, see the lower anchor point and a higher anchor point. Those 2 reference points, and that's what this level is here. Consequent encroachment of that stop loss has to be just below that. Why? Because this Venom model is a balanced price range, and it should not come back down here. If it does, it's not a Venom, and it's probably going to be a wrong trade. Okay, I'm not going to be profitable if it goes down to consequent encroachment or less than. So I can put a stop loss just below that and feel confident that it's okay. And the market daily dies around in here and then sends it higher.
Okay, so I was wrong about the stop loss being at the low. ICT answered some of my questions on the second suggestion. Also, I guess you may not get this entry on the second fair value gap because it is a balanced price range and may not come back into it. So I guess that's why he entered on a stop at the opening price of this candle, pretty much at the change in the state of delivery.
As I was watching this, I'm smiling to myself because I know it's going to go up here and take that out. But I forgot that I was only supposed to be taking trades with 30 in the morning, 20 in the afternoon. So I lost sight of everything. I got punch drunk because I was watching a live streamer in their chat window and whatnot. So I just collapsed the trade there and was content with that. There's no real reason for anything except for I didn't follow what I was setting out to do, and I was wanting to showcase to you all here. So this is me not following the outline I set for all of you, but still, nonetheless, it's still fun to see it. And ultimately, it goes above the 19,300 and these highs in here. It comes back down in, reaccumulates. And all of this is occurring also around the opening range gap low of the 25th. Note that. So there's several things there. We have a market maker buy model. Okay. And I'm buying at the low risk buy. And you could have done accumulation, reaccumulation, and then send it up there like that. That would have been wonderful for a market maker buy model. And then it continues actually going higher. And you can see it rips through that old volume imbalance in the daily chart after using the old opening range gap of the 25th. And then watch what happens here. We trade back down into that opening range gap, but look at the body. See that right there? I love seeing that. It's telling you that, okay, we stop here. The next candle should go bullish. It opens slightly below it and then quickly rejects it, takes the buy side. Look at these candles here. See how smooth they are? Where there's smooth price action, it becomes jagged. It rips through it here. Next buy side is here. It pummels that rather. And we have this consolidation in here. And they bump it right up into new week opening gap for this week. Lots of price action delivery in here. Consequent encroachment. Look at the bodies. That's so beautiful. So it drops back down, takes out the sell side here, and gravitates right back up to the new week opening gap low. This run here to there, that small little scalp right there, that could be your whole model. That'd be just what you're looking for, your model. See this wick? Okay, I usually turn this into a 4-hour video, so I have to be careful. Do it, ICT, do it. All right, you see that right there? Consequent encroachment of this wick. It's a discount wick when price goes above it. If you know it's likely to draw back into the new week opening gap. As soon as we break above it, the next candle we open, trade down to it there, boom, there you go. There's your entry. And this portion should stay open as well, a breakaway gap. And it rallies right back up into the short-term buy side here and back into the new week opening gap below. And now we're just hammering around. This is kind of like typical trash Wednesday afternoon of non-farm payroll. Thursday, I've already told you what I think is likely to be a long-term daily chart. It's not that it's long-term, but that's my higher time frame for day trading. Where short-term trading is the weekly chart. Swing trading is the monthly chart. So by having that understanding that we could potentially trade higher on the daily chart, Thursday and Friday going into it, I'm looking for reasons why the market may want to justify running to those levels as I indicated on the daily chart. Here, it's just, to me, you shouldn't be doing anything with this. And I know we're in the last hour of trading. I don't like to trade the last hour trading on non-farm payroll weeks, Wednesday or Thursday. Friday of non-farm payroll, absolutely. Absolutely, I love doing that. But just know that on your notes in your journal for Wednesday and Thursdays of non-farm payroll, Fridays, final hour trading, it's a big gamble. Sure, you might have a big win and might be thanking yourself that you didn't listen to me when I said it, but I'm speaking to new students, new traders. Trust me, it's better to do this than to go out there trying to gamble and either it doesn't do anything or it does something unexpected and hurt you. Okay. This week is one of those weeks where you can very easily get hurt and not fully understand why. So you have to dial back your level of exposure and risk. That means trade frequency falls off precipitously, your leverage falls off precipitously, and just be content with what you can do on Monday and Tuesday, and maybe London session or Asia Tuesday night into Wednesday. Okay, and limit your trading to that as a new trader. And just watch, just paper trade or tape read on Wednesdays, Thursdays, and certainly for non-farm payroll Friday.
So I like the higher time frame analysis in the beginning, but then it gets confusing. Hard to follow. He glazed over a lot of stuff, but if you were interested in any parts, I encourage you to pause the video and really analyze what's going on. You saw how much I went over when I paused at the Venom model. When you pause and really take a hard look, you'll be able to see a lot more than when it's just passing by. Anyways, the lecture was a lot easier to follow once we started on Wednesday's price action, and then at the end, a little motivational speech. So overall, a pretty good lecture. You can tell the Venom model was the part I was most interested in. Let me know in the comments what caught your eye in this video. If you liked it, please smash that like button and subscribe for more videos like this one. And until I see you next time, safe trading.